Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, the 2nd of December of 2021. And yes, we finally made it to the last month of the year. It feels like it's flown by. I don't know about you, but everyone in the Schein household, we put up the Christmas tree this last weekend and we are now ready for Santa Claus. That being said, we're also waiting for the Santa Claus rally, and we haven't seen anything since, or anything of the like since early last week, and then obviously beginning of this week. Right now, we do have a rally taking place on all the major indices, but the first 2 days of this trading earlier this week, even more, we saw quite a bit of volatility and turbulence. Obviously, we saw the Fed Chairman Jerome Powell speak about taking out the word transitory. I talked about that this last Tuesday. And then couple that with what we discussed about when I talked to Bloomberg Radio last Thursday on Thanksgiving, on the breaking news of the Omni variant. Now in the United States, it's here. It's on our shores, and overnight it seems to be everywhere. We're reading reports from San Francisco to Minnesota, New York, and just about every other state right now. And it's amazing because we couldn't even test for it, but now we have tests. Like a week ago, the health organization said we don't know, and now they have it everywhere. So why are the markets jumping or manic depressive or high volatility? Well, let's go back a couple of days where in the press, obviously we had the unexpected sort of pivot by the Federal Reserve, Jerome Powell basically saying transitory is no longer a term that they're going to use anymore when it's regarding inflation in the economy. They basically said inflation's here to stay. Well, if you watched us for quite some time, that's what we've been discussing for well over a year now. Inflation is here to stay, and that's why we have to position our clients appropriately, accordingly, to take advantage of what inflation ultimately does is it rises assets, not without volatility along the way, but you want to own assets, real assets, stocks and real estate and commodities and a few basically asset classes that are just going to rise ahead of inflation. So markets know this, that's why markets have been up. But in the recent, when the Federal Reserve positioned their posture, they basically said, oh, by the way, it's here to stay, and we might have to take the punch bowl back faster, meaning the accommodative policies. That's the first punch, and that's why markets went down. The second punch was when the Biden administration, President Biden said, and he basically said, and as soon as he said this, the markets gapped down, and we had a huge down day and a reversal in the markets when President Biden said lockdowns, because of the new Omicron variant, are off the table. Now, what the market does is read through things, right? And so as politicians go out there and they basically speak from the podium, they're basically trying to calm everyone's sort of fears or worst case scenario. In this case, what has happened is the policymakers in the United States, everyone, both blue and red and everywhere in between, every time they say something, whether it's weeks or months later, they have to retract or reverse their original opinion. So when somebody says, like the governor of California, lockdowns are off the table, or the president of the United States says lockdowns are off the table, essentially the market's reading through that and saying, oh my goodness, they are floating the idea in the worst case scenario. So it's a trial balloon. Markets aren't too worried about the variant itself. In fact, the doctor that discovered this in South Africa basically said it's mild, very mild, but spreads extremely rapidly. And also think about all the therapeutics, all the vaccines, everything that we have to basically arm ourselves here and around the world. We're very much different 20 months later than we were when we first initially discovered this. Now, keep in mind, if you were right about the initial COVID-19 breakout, meaning if you're in the medical world saying it's going to be really bad, and it was, and we had lost lives around the world, but then at the same time, you're also an investor and saying, oh, we're also, coupled with that, we're going to lose like a lot of money and everything. It's going to be the end of the world, right? Those two kind of go hand in hand. Well, if you were right about the outbreak and the COVID, you were wrong about the market. The market actually dipped down for a couple of months, both March and April of 2020, and then it reversed course for several reasons, but we haven't seen a bull market rally like this in quite some time. Again, fast forward to right now. The Omicron variant right now, it's concerning, right? It's concerning for all of us, all of our public health officials, how we go about this. But I will tell you, you can't jump to conclusions as an investor, because if you were making the same base case scenario last let's say March of 2020, and you did bet what the coronavirus was to be relative to investments, which means a huge negative down and stay down, that was a wrong bet. So markets are not reacting to the Omicron variant. What they are reacting to are the lockdowns, simply because when politicians say something, they pivot. When health officials say something, they pivot, and they either change the goalpost or they reverse course. They have no problem saying, you know what? They don't even say they're wrong. They just say, we're going to do this now, and they completely disregard what they said before. The markets are sniffing this out, and that's why the market volatility is really there. Because if we have another shutdown, if you will, again, the public health debate is off the table. We're talking about markets, how they interpret information, and how we invest for our investors. So keep that in mind. This is not a public health conversation or debate. This is what markets interpret and how we are positioning our clients accordingly. So when markets read through headlines like that, they basically are saying, no, we can't sustain economically another shutdown, because we can't go write another $2, $3, $4, $5 trillion both of fiscal and monetary policy to support another sort of lockdown or shutdown of the U.S. economy. That's where the fear is. Now, how do we know this, Rob? Well, simply because if you look at the delta, sort of the difference, that's the delta here, between the 2-year and the 10-year of the treasuries. It's a flattening of the yield curve. So what that means is that it's getting a steeper or flattening. Steeper is this way, flattening is this way. It's probably this way for you guys. So this is the 10-year, this is the 2-year, so I got to reverse that. And as they get closer to each other, when the long end of the yield curve, so the 10-year, gets close to the short end or flattens out, is what we call it in the financial services industry, that means that it's something to be concerned about. It could be a precursor to a recession. We will see a recession if the long end then dips below the short end. That is almost about 90% of the time indicative of a future recession ahead. So now that checks. The Omicron variant is going to check the Federal Reserve right now and put them on sort of on the back burner, because the Federal Reserve now has to sit there and say, wait, we're getting great unemployment data. That's their number one initiative, right? But at the same time, they also have to then take a stimulus away, which they have to think about that. And they have to deal with the information from the unknowns, as I talked about earlier this week, which is how this Omicron variant will play out. So the yield curve is telling us this. Now, the stock market is basically off of the S&P specifically. We also look at internals, so the strength of the moving averages. So the 50-day moving average and the 200-day moving average. Right now, the 50 is still ahead of the 200-day, so we don't have any major breakdowns significantly, technically speaking, on the S&P. So that means that we're waiting for viable opportunities as we're seeing them. Today could be one, today could be a bounce. We're going to wait and see. We want to see how the 10-year and the 2 to 10 spreads, or the delta, if you will, play out. And then also, this is a viable indication when we get down to only 20% of the S&P are above their 50-day moving average by index or by stock. And right now we're at 29% that are above the 50-day moving average within the S&P 500. That just means a technical look of how that stock is trading relative to its 50 and 200-day moving average. It's really viable signal when this gets down to 20%. So we're in the zip code, we're in the neighborhood, but we haven't seen the 20%. Okay, let's go ahead and buy this right now. So we're dipping our toe in. We have been yesterday and the day before for our clients, repositioning portfolios to take advantage of this volatility, as I always stated before. But in the middle of this, now what markets do know, right? This is what matters, right? The 10-year treasury, as I talked about, what the Federal Reserve does with interest rates, that matters. How the market reacts, the S&P 500, both internally and technically, that matters, because we don't want a technical breakdown, and we haven't seen that, so that's a good sign. But right now, in the middle right here, we have 24. Rob, what does 24 mean? Well, I had to look it up, even though I was in a fraternity way back when, and the Greek alphabet is 24 letters. Now, that means that plus or minus, depending upon what you want to look at, because we just skipped one alphabet letter for unknown reasons, but you could ask the who, why. We have about 9 more to go. So what that means, take home point is, markets know that we have more variance to come. And so don't be shocked or surprised if we skip a couple more letters and down the road, there is something bigger and worse, God forbid, than what we're currently dealing with. What we can't handle and sustain on a go-forward basis are the lockdowns. And that's why you're seeing the volatility in the market. So we will see how politicians play this. We will see how the Federal Reserve sort of behind the scenes navigates through this. And more importantly, we'll see how this unknown, i.e. the virus, reacts and behaves. And we just pray every day that we have our science, thank you science, to stay ahead of this, not behind this. But in the meantime, the market is keeping up at night to make certain that, you know what, either it's nature's course of science, or can humans actually create something to stay ahead of science? And whether we have 9 more variants, and that's the problem, it's in the rear view. So every time we keep talking about a variant, we've got a vaccine that's in the rear view. So that's the biggest challenge we're dealing with now. The key take-home point, we do not need and we can't sustain economically another shutdown. So we're going to be paying attention to that very closely, as well as the Federal Reserve. So that's the update for today. In the meantime, we've got a rally in the markets. Thanks for watching, and we'll catch you again next time.